A couple of days ago on Monday morning before the bell, SoFi reported their third quarter financial results and smashed all earnings expectations out of the water, yet the stock only closed up 1% after surging up 13% and then giving it all back intraday. I spent hours digging into the numbers, and in this video, I'm going to go in depth into the press releases, the earnings presentation, the earnings call, and further interviews that Noto did on Bloomberg and CNBC to try to make sense of some of the numbers. It's going to be a big video. Let's jump right into it. So just like in previous quarters, we've covered SoFi earnings live in the moment on the channel on Monday morning. I mentioned in that video that SoFi continues to blow all expectations out of the water. This quarter was absolutely no exception to that. SoFi triple beat on the numbers, continuing their long streak of beating revenue expectations, bottom line expectations, and raising guidance consistently. I think they've done so consistently every single quarter this year so far. Now, I'll break this video down for brevity. Let's first start with members, products, revenue, and EBITDA, and then we're going to move into lending, tech platform, and FinServe segments before talking about some of the expenses and the earnings call and other little important aspects such as selling loans and obviously guidance. Okay, so starting off with members, SoFi reported record new member additions of 717,000 new members in the third quarter, bringing the total member count nearly 7 million. This is a 47% increase year over year. Now, not only did this beat all of our expectations, I think our highest expectation was Stephen Fiorillo's guess of 604,000 members. And this is over 100,000 members in addition to that, on top of that, right? So this is absolutely a spectacular number. It's by far an acceleration in the member count, which is obviously bullish because as SoFi has a larger base of members, it becomes harder to add incremental members on an accelerating percentage basis, which is exactly what they're doing. Now, it's also positive because management has reiterated the fact that in 2024, they're aiming to have nearly 800,000 all the way to 1 million net new members per quarter. And having these step improvements in member and product counts as we start to head into the new year is positive because we can more accurately model out SoFi's growth with a higher level of confidence because it's not a huge step change that they're going to have to make in 2024. It's more of a gradual progression upwards. One thing, however, to pair some of these expectations is that Anthony Noto mentioned in the earnings call that in Q4, the focus would be on profitability, saying in terms of the outlook for member growth and product growth, what I'd say is we have largely been averaging in the 400,000 member range. I wouldn't start assuming that we're going to average over 600 or 700,000 members today. I think you could start to focus on 500,000 plus in a quarter, essentially as a new baseline. We've really been focusing on driving to profitability. And as we go into 2024, we haven't set our plans yet. So I wouldn't set this as a new level. This was an extraordinary quarter. Can we repeat this quarter? Yes, but I wouldn't plan on it. So I keep the outlook for members in the 500,000 member range for now. So that's definitely one factor to keep in mind with regards to the members. And of course, we're going to talk about expenses, including sales and marketing for the quarter and how this all affects member count. But in terms of the member additions for this quarter, absolutely bullish top line number. I think everybody was blown away by this number, especially considering the acceleration further. Moving on to products. In terms of products, SoFi reported a record new product additions of over 1 million new products in Q3, coming in at 1.05 million, bringing the total to 10.4 million products, which represents a 45% year-over-year increase. Now, we've crossed this 10 million product threshold, and I think my favorite part of this is that the ratio between products and members still sits at 1.5x. Growth in products and members were driven primarily by financial services products, which reached nearly 8.9 million, which represents a 50% year-over-year increase. Lending products, by contrast, increased 24% year over year. And for those of you who are new to SoFi, asking yourselves, well, how is financial services simultaneously growing the fastest despite being the biggest segment? Don't forget that lending is where SoFi makes the majority of their money, right? And there's far fewer barriers to financial services for new members. So just think how many people are taking on a new mortgage right now or taking on a big personal loan right now, and contrast that with how many people are opening up an invest account or a checking account with SoFi. obviously you're going to have more people on this side opening an invest account or a checking account because it's easier to do. There's fewer barriers to entry. But SoFi will make way more money on this other segment on the lending side, because if you're taking on a mortgage or a personal loan or a student loan, obviously those are bigger ticket items in terms of the money that SoFi can gain from that member. And so you have this discrepancy between financial services being faster growing and being higher in terms of total members, but lending being the more profitable segments where SoFi makes the majority of their money. And now that we've talked about this, the important thing that bridges these two factors together is the financial services productivity loop. So basically, this is one of my favorite slides. What it does is it gives us a good indication of that financial services productivity loop. As of Q3, SoFi reported a 5.6 times ratio of financial services products to lending products. Why does this matter? Well, because one of the strategies to maximize cross-buying is to onboard new users on low barrier to entry products. So for example, the Invest app or a checking account or SoFi Relay. And once they enter the SoFi ecosystem and get familiarized with it, SoFi can not only collect data on these members, but it can also recommend new products for them to try. And especially it can recommend more profitable products, such as lending products, for example. Once it validates their credit score, their repayment history, all these kinds of details that it can collect from the low barrier to entry products. Now, management highlighted that the financial services productivity loop has reached an inflection point, which creates not only marketing efficiencies, but further improves this cross-buying ability of essentially members trying out different products. And so one of my bull thesis for 2024 and beyond, as SoFi continues to scale, is that 1.5x ratio of members to products increases. Basically, you have members that are trying on maybe 2 or 3 or 4 SoFi products, because what that will do is it will validate that cross-buying strategy. Okay, so without going too in depth onto that, I wanted to also touch onto revenue and EBITDA and the net loss very quickly, because I think this was a cause of some confusion across the street and also some bearish sentiment that I saw out there as a result of the earnings. SoFi reported records in both GAAP and adjusted revenue for the third quarter. The GAAP net revenue came at $537 million. The adjusted net revenue was $531 million. Both were up 27%. They also reported record adjusted earnings before interest, taxes, depreciation, and amortization, EBITDA, of $98 million, which is up 121% year over year. So all those three are great. Now, the discrepancy is between the net loss numbers from a GAAP and a non-GAAP perspective. And the reason why is because of a goodwill impairment charge. Basically, without this impairment charge, the net loss from an EPS perspective, earnings per share, was negative 3 cents. And this is a big beat, right? Because analysts are expecting negative 7 cents EPS. And by the way, negative 3 cents EPS is exactly the number that I'd predicted in my forecast. However, many news outlets, what they did is they went ahead and reported the GAAP numbers, which reflected this goodwill impairment and lowered SoFi's EPS from the negative 3 cent number all the way down to negative 29 cents. So basically, it seemed as though SoFi had a gigantic net loss when in reality, it was an accounting difference. And this was a big difference, right? Because the GAAP net loss, the negative 29 cents, corresponds to a $266 million net loss, whereas the adjusted number is only a $19 million net loss. So where does that remaining $243 million come from? Well, basically, what a goodwill impairment is a non-cash charge, and it came in this case from the Technisys acquisition. SoFi acquired Technisys back in 2022, and it overpaid for Technisys. I think it paid something in the order of $1.1 billion. And it turns out that by looking at the specific details for Technisys, SoFi overpaid. And in order to balance the books from an accounting perspective, they have to write this off, and that gets written off as a goodwill impairment. And that overpayment was $247 million. And obviously this is recorded as a loss, even though the actual acquisition for Technisys was completed in 2022. So it left their cash balance in 2022. This is why I say it's a non-cash loss, because it doesn't reflect in their balance sheet. It doesn't reflect in their numbers and the cash that they have on hand. It only reflects from an accounting perspective. And all that to say is that this goodwill impairment does not negatively impact SoFi's ability to execute today, nor does it affect their ability to reach profitability next quarter, nor does it affect their cash position today. In fact, intangible goodwill must be tested for impairment on an annual basis. This happens about once a year to ensure that the value of assets is not inflated. In this case, the asset is Technisys. So this is a one-time adjustment and it will not reflect moving forward. And they actually had to do it this quarter because if they had done it next quarter, they would have not been able to, on a GAAP perspective, report a profitability, right? Because it would have been $247 million less from an earnings perspective. So it's actually good that they did it this quarter because they got it out of the way and they can still maintain that promise of Q4 profitability from both an adjusted perspective and a GAAP perspective. Okay, so now let's dive into some of the individual business segments, starting off with lending. Let's start off with product growth since that we've already been talking about products a little bit. Now, of the 24% year-over-year growth in total lending products that we saw, the majority of that came from personal loans, which increased 35% year-over-year from a product perspective, and was followed by an 8% increase in student loan products and a 10% year-over-year increase in home loan products. The lending segment revenue was up 15% year-over-year, driven mostly by net interest income, which increased to 90% year over year to $265 million. Now, as we mentioned in the Q2 earnings recap, if you haven't seen that, definitely go watch it. Net interest income is associated with a bank's main revenue driver. So we want to see that rising even if the non-interest income is falling. This is normal. And even if you look at it on a one-to-one perspective, the net interest income increase offsets the non-interest income decreases. Expenses increased by 19% to $135 million from $116 million the prior year. Yet despite this, the contribution margin stayed fairly consistent at 60%. And as always, the lending segment, like I mentioned before, is a profitable segment. The contribution profit for this segment was up 13% to $203 million, up from $180. Now, as of the end of Q3, SoFi had about $20.9 billion in loans held for sale, with about 3/4 of these being personal loans and the remaining 1/4 being student loans. From an originations perspective, total origination volume increased 48% year over year on the back of personal loans, which carried a 38% year over year increase to $3.9 billion. Up $1.1 billion. Student loans also saw a pretty big lift. This was one of the surprises for myself that I commented in the live stream on Monday. It came in well above the numbers that we had all predicted. Last quarter, the student loan originations came in under $400 million, and now that the student loans have resumed as of October, we expected originations to be somewhere in the ballpark of 650 to 750 million, but SoFi student loan originations for Q3 actually came in at 919 million, which represents a 101% increase year over year and a 133% increase quarter over quarter, which just goes to show how impactful this student loan decision is to SoFi and to borrowers who basically prepared to resume student loan payments in October. Now, one thing I will say on student loans is we expect this acceleration to continue going into Q4 and going into the new year. Back in 2020, before the moratorium, SoFi was doing multiple billions of dollars in terms of originations, and this is just the beginning, right? So student loans is going to ramp up in a very, very quick way. Finally, onto home loans, their third business segment in the lending category. These were up 64% year over year to $356 million. Management highlighted they began to see the benefit from the integration of Wyndham Capital Mortgage with an improved fulfillment capacity from their acquisition at the beginning of Q2. So all three segments in the lending category are up. Obviously, personal loans, surprising that it's still up given how much it's increased this year. Student loans was the biggest shock for me, and I really enjoyed that they also mentioned Wyndham Capital's integration as early as Q3 because that was something that closed in the beginning of Q2. Let's pivot now onto the tech platform. Total accounts increased 10% to 136 million. Management validated their strategy in the earnings release, saying, quote, "The company has made great progress on our strategy to sign larger and more durable clients. Additionally, there is a robust pipeline of ongoing discussions with potential buyers with large existing customer bases across both the United States and Latin America, spanning both the financial services and non-financial services segments. This is great news, right? And for a couple of reasons. Firstly, management has mentioned how they are expecting to see a re-acceleration in the tech platform until the end of the year, and it seems that they're executing on that consistently. Secondly, management has doubled down on the strategy to chase bigger deals. They were talking about this in the beginning of the year when they lost Current, which was their second biggest client. They said, hey, we want to chase bigger deals because, yes, while there might be a longer lead time for us to even close these deals, it might take longer, it might be more rigorous. It's actually stickier for us to close these deals because these companies have higher switching costs than something smaller. And finally, third, management has mentioned that they're underway with pilot programs of legacy institutions that are basically piloting Galileo, and this naturally takes a long time to finish. And all of this is very bullish for the tech platform. All of it actually contributes to this record net revenue in the tech platform, which was up 6% year over year to 89.9 million. The tech platform also reported a record contribution profit for 32.2 million, a 65% year over year increase. And in addition to this, expenses for the tech platform actually fell 12% to 57 million, bringing the margins up to 36%. So you have here like this perfect storm, right? Revenues increasing, profits increasing, margins increasing, expenses decreasing, and the overall strategy is absolutely working, right? And we've been seeing this a lot anecdotally, right? With regards to the velocity of new products that Galileo has even been releasing over the last quarter. It seems as though every single week Galileo is releasing a new revolutionary product for large scale enterprise businesses. Now, management highlighted saying, quote, we are seeing continued diversification in our client base and revenue growth, along with a strong adoption for new product offerings, including Connecta, our natural language AI-driven intelligent digital assistant, and our payment risk platform, a platform which leverages transactional data to reduce transaction fraud. Now, both of these, with regards to the AI-driven digital assistant, which basically cuts down operational expenses for these end businesses and makes it more efficient for them to run their business, as well as the risk platform, right? Transaction fraud is one of the biggest risks that these large institutions have. Both of these are pillars in terms of what these enterprise clients are looking for, and Galileo basically fulfills both of those needs in a very fundamental way. Management basically promised us that the Galileo accounts would be up and that the margins would be up towards the end of the year, and they're absolutely executing on that promise. I expect much of this to continue into Q4. Finally, let's chat about financial services segments before moving on to guidance, profitability, and some of the highlights from the earnings call. This is going to be a big video, like I said. So let's keep it consistent, right? And let's start financial services from the top with regards to product count. As we saw at the beginning of this video, the vast bulk of the product growth, as I mentioned, was due to financial services. SoFi grew total financial services products by 2.9 million, 50% year over year increase, bringing the total to 8.9 million at quarter end. Here's how that product count breaks out. As you can see, there's 6 categories of financial services. They're all rising by double digits. However, the main contributors are SoFi Money products, which have increased 53%, a record of nearly 371,000 products. Remember that SoFi Money is the business segment, which includes SoFi Checking and Savings account held at SoFi Bank. SoFi has consistently been increasing their APY benefits, even as recently as last week. They actually increased it again to 4.6% with no minimum balance, $2 million in FDIC insurance, and all of these benefits basically drive a huge influx of deposits to SoFi Bank. The company highlighted that their total deposits grew by $2.9 billion, up 23% quarter over quarter, to 15.7 billion at quarter end, and over 90% of SoFi Money deposits, inclusive of checking and savings and cash management accounts, are from direct deposit members. And more than half, over 50% of newly funded SoFi Money accounts were setting up direct deposit by day 30. This is absolutely fantastic to see for the SoFi Money segment. Moving on, Relay also posted record growth, 405,000 new products for Relay, 85% year over year increase. Invest also posted 150,000, a 19% year over year increase. And financial services as a whole segment reported their first ever profitable quarter, barely squeezing through with $3.2 million in profit compared to a $52 million loss last year. Management highlighted that this profit came as a result of continued improvement in monetization for the segment, along with increasing operating leverage as we efficiently scale the business. Monetization progress is underscored by annualized revenue per product of $53, which grew 61% year over year. Operating leverage is evident as the segment generated $69.3 million in incremental revenue with only $13.4 million in incremental expenses versus last year. So similar story here with regards to the split of that revenue coming predominantly from net interest income, which rose 231% year over year to $93 million. Non-interest income, by contrast, also rose for the financial services segment 21% year over year to $25 million, bringing the total net revenue for this entire segment to $118 million, which represents a 142% increase year over year. And the most impressive part, in my opinion, of all of this is all this happened and expenses only increased 13%. I thought this quarter was absolutely fantastic. Top line numbers, all the lending segments going up, financial services humming along, being profitable now with only a 13% increase in expenses. The tech platform, basically all the metrics are absolutely positive. And so, I thought this was a stellar quarter. And really the final nail in the coffin that made me believe that was guidance. Management, in fact, raised guidance expectations again for the full year 2023. And I think they've consistently been raising guidance every single quarter this year, right? In this diagram, you can see their original 2023 guidance. They said about 1.9 to 2 billion, which increased again in Q2 and then again in Q3, going from 25% to 30% in year-over-year revenue, going to what it is now, 33 to 34%. And on an adjusted EBITDA perspective, the company expects 386 to 396 million in adjusted EBITDA, which represents a 48% incremental adjusted EBITDA margin. And one thing that I think a lot of the market was looking for was SoFi to reiterate this Q4 profitability, for nothing unexpected to have happened to push this out, which the company did, right? Especially now that all three business segments are in fact contribution profitable, the company basically reiterated the fact that they are humming along for Q4 profitability. However, they did also mention that management expects depreciation and amortization and share-based expenses all to increase in the mid to high single-digit percentage range for Q4. So basically we said that, many of these expenses were down. They expect a little uptick in Q4 for some of these expenses. And we're going to talk about SBC in just a second. So we know that profitability right now is really a key indicator for SoFi, as this is essentially what management has been reinforcing since the beginning of the year. And as we look forward, there's two numbers I want to bring to the forefront. The first is sales and marketing expense. We know S&M expense leads to higher member counts, and what this does is it amplifies SoFi's growth even further, but it's also the company's biggest cost. As of Q2, this was 37% of revenue at 182 million. As of Q3, this increased on an absolute basis from 182 to 186.7 million. So higher on absolute, but actually lower as a percentage of revenue, actually 35% of revenue. And in fact, sales and marketing expense as a percentage of revenue has actually declined for the fourth consecutive quarter. Another thing to keep in mind here is that SoFi added 584,000 members back in Q2. They added 717,000 members this quarter, and they did that all with an additional $4 million in sales and marketing spend. Management highlighted that, a lot of these member additions were due to referrals and were due to organic growth. So much of their strategy is actually playing a part in terms of it not being a pure one-to-one correlation between what they're spending in marketing and the clients that they're coming in. And this is absolutely good to see, right? Because this is the flywheel at work. If I sign on to SoFi and I enjoy their product, I'm going to refer more friends and family onto that product as well. And ultimately what this does is it lowers the customer acquisition cost by quite a bit, basically to say that, all of these members that were acquired organically or through referrals are done so super cheaply. But in Q4, I expect sales and marketing spend to actually fall on an absolute basis as well, as this is one of the financial levers that the company can pull to manufacture that profitability more sustainably. Now, the second number that I'm going to note is stock-based compensation. In an absolute dollar terms, this is the lowest it's been in the last 2 years, SBC came in at 62 million for the quarter. It's also the lowest it's ever been as a percentage of revenue, around 11% of revenue. In fact, management also highlighted that for Q3, adjusted EBITDA of 98 million exceeded the stock-based compensation of 62 million. So this is all very positive, right? Because it shows that all of these metrics are moving in the right direction. And I mentioned that profitability now seems like a foregone conclusion for the company. And of course, as I mentioned, management did warn us about SBC amortization and depreciation all increasing towards Q4. So that's something to definitely watch out for, but it gives me no doubt that they're actually going to reach their profitability numbers, especially because they've reiterated this even as early as this quarter. Now, of course, the goodwill impairment messes up some of the numbers from the GAAP perspective, and it also leads to a couple of misleading headlines. If some of these analysts choose to look at the GAAP numbers, it looks like SoFi had a huge miss when in fact they really didn't. But as I mentioned, this goodwill impairment is a one-time charge, and they had to record it this quarter in order to report GAAP profitability next quarter. And this is also important because the earlier that they report GAAP profitability, remember S&P 500 inclusion is a big thing that people are going to start to look at in 2024, because 4 quarters of profitability is basically one of the requirements. And the earlier that SoFi can do this, then the earlier that they can basically be eligible for this. And what that unlocks is large funds being able to buy in. Now, much of the earnings call centered around selling loans, so I'll basically cover that very briefly, even though I think we're super over time. Selling loans has been a topic of discussion among SoFi shareholders and skeptics, as SoFi will essentially be required to sell loans within the next 2 to 3 quarters. Why? Well, because SoFi holds loans for sale, not necessarily holding them to maturity. However, with a high interest rate environment, SoFi has chosen to hold these loans onto their books for longer than usual, and eventually will be required to offload these loans very shortly. SoFi's Chief Financial Officer, Chris Lapointe, touched on their progress in his opening remarks, as well as answering some questions around this in the Q&A portion. And a lot of this stuff, I think, put a lot of investors' worries to ease, because this was one of the things that investors, and especially the more bearish analysts, were pointing to as SoFi is going to be in big trouble. Chris Lapointe basically said in his opening remarks that they sold personal loans at an execution level of 105.1% and sold home loans at a weighted average execution of 100.02%. He continued to say, quote, "In addition, last week we executed a $100 million sale of personal loans at a 105.1% execution to the same partner who purchased personal loans in Q3. And we agreed to terms with that same partner for a $2 billion forward flow agreement at a similar execution. We're also in the market, including in discussions with funds and accounts managed by BlackRock with respect to a $375 million securitization at a favorable execution level, and that's expected to close mid-November." So pretty much that entire paragraph is Q4 related, but it highlights that SoFi is selling their loans, and this partnership with BlackRock, BlackRock is like the biggest asset manager in the world. It's absolutely fantastic, right? And especially if they have a partner for a $2 billion agreement to sell more loans at a favorable rate, this puts everybody's worries at ease, I feel like, from a loan perspective, because we now have clarity as to that strategy. Chris Lapointe, SoFi CFO, also answered some questions on capital ratios, basically saying that they're well above the regulatory requirements, sitting at 14.5% versus the regulatory minimum of 10.5%, and basically adding later that management expects these benefits to persist despite the macro backdrop. So just to put this all into layman's terms, SoFi's already begun selling loans in Q3 at a favorable rate and is selling much more in Q4 and probably much more going on in 2024. But I will finally conclude this video with a portion of Anthony Noto's closing remarks, because I think that it encapsulates the earnings results very well, and especially my sentiment around the earnings results in one single statement. Anthony Noto on the earnings call said, quote, "I remain confident that no company is better positioned than SoFi to be the winner that takes most in the digital transformation of financial services. Personally, I think this was a fantastic quarter. I could not have asked for anything more. Pretty much close to a 10 out of 10 quarter if it wasn't for that goodwill impairment, which is basically the ammunition that a lot of these bears and analysts will essentially use, even though it's a gimmick. It's like an accounting thing. They will still use it to say that, SoFi missed or to post misleading headlines. But I think from an execution perspective, it was a 10 out of 10 quarter. I could not have expected anything more. Management answered pretty much everybody's questions and uncertainties in that earnings call. And I'm perfectly happy with SoFi actually, bought more SoFi on the Friday before the earnings. And, I'm really, really looking forward to Q4 to see the company actually be sustainably profitable. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.